I am Carlo Bustos, Educational Programs Leader at Proformative, the online community for corporate finance, accounting, treasury, and related professionals. I would like to welcome everyone to today's webinar, Taming Revenue Recognition, Best Practices to Ensure Compliance. The landscape of revenue recognition is challenging for many firms, with FASB and the IASB regulations that continue to evolve, especially in light of the revised exposure draft that will be applicable to most businesses. CFOs need to stay ahead of the statutory requirements to ensure that their financials and their ERP systems will adhere to the changing standards. Our speakers today will discuss best practices based on revenue recognition processes, as well as practical lessons that focus on creating end-to-end revenue recognition processes. I'd like to thank Netsuite for helping us make this event possible and their generous support, for which helps us deliver this webinar at no cost, just like everything at Proformative. And now a few housekeeping items before we get started. I would like to welcome you back to Proformative. Just a brief overview on Proformative for those of you who may be new to our community. We are the largest growing online community of finance, treasury, accounting, and related professionals. We are an ad-free, noise-free community where we encourage and expect peer-to-peer collaboration. Check it out at proformative.com. And now just a few event notes. This is just a reminder that the link to today's presentation and the recording of this webinar will be sent out to all the attendees within 24 hours of the event. The presentation is currently posted on proformative.com/resources for you to download and follow along if you'd like. Those of you who would like CPE credits will need to answer all 3 polling questions during today's webinar and should have pre-registered for it. If you have any questions around the CPE credits, please contact Chris Brower at proformative.com. We really encourage everyone to ask questions during today's event. We have 2 great speakers who have great experience and understand this topic really well. And so we encourage you to utilize the questions box in your GoToWebinar control panel and continue to ask questions, and we'll look to get to as many of them as we can throughout the event. And lastly, at the end of our session, you'll be asked to take a quick short survey regarding the webinar, and we greatly appreciate your feedback regarding the event, as we always try to improve the ROI and the content that we deliver throughout. And before we get started, just wanted to highlight a quick aspect of the learning objectives that we look to achieve today. After participating, you'll get a better sense of how to define the new revenue recognition regulations and how they will impact your business processes as well as your systems, and ways that you can get prepared to adopt them. Determine how to overcome some of the internal challenges based on the complexity of these new rules, including how to work within processes, systems, and personnel. Also develop a practical approach on how to more accurately calculate revenue allocations, reducing the manual reconciliations, and ultimately establishing centralized controls and compliance monitoring in order to ensure a full audit trail. And lastly, to understand how to approach revenue reconciliation challenges that arise through M&A activities. So getting started, it gives me great pleasure to introduce today's first speaker, Albert Ryan. He is a Principal Solution Consultant at Netsuite. Albert is an Irish Chartered Accountant, having trained with Ernst & Young. He has worked as a controller across a range of industries over the past 20 years, including software, consumer products, real estate, and financial services. He served as a controller for Canon Software in 2008 when they implemented Netsuite One World. More recently, he served as a controller for Rockstar Energy Drinks and for Armored Auto Group, the manufacturer of the STP and Armor All Auto brands. He has also worked as a revenue recognition consultant for a number of high-tech companies. At Netsuite, Albert serves as Principal Solution Consultant, where he advises controllers and other financial executives how to solve some of their most challenging issues in back-office management. Take it away, Albert.
Thanks very much, Carlo, and welcome participants. Before we review EITF 0801 best practices for compliance and our RevRec processes here at Netsuite, I'd first like to provide you with an overview of Netsuite, the company. Netsuite was founded in 1998 and we went public in 2007. For the year ended 2012, we generated $308 million in revenues, and we ended the year with a little over 1,500 employees. In addition to ERP and financials, NetSuite offers a broad range of applications such as CRM, professional service automation, and e-commerce, all in a fully integrated suite. We deliver our services over the internet as a subscription service using a SaaS model. Currently, we have over 16,000 customers, and of course, NetSuite uses NetSuite to run its business. So, why is revenue recognition so important? Firstly, the revenue number is viewed by users of financial statements as a significant indicator of company performance. And additionally, it is normally the largest item in the financial statements of a company. And investors place significant weight on the revenue number, as revenue trends tend to be key barometers of companies' performance and future prospects. Additionally, the revenue calculation is a critical and complex area for the preparers of financial statements, as I'm sure everyone on this call is painfully aware of at times. And revenue recognition issues tend to be the most common reason for financial statement restatements. A recent Wall Street Journal article noted that revenue recognition was the leading cause of restatements for U.S. public companies in 2011 and 2012. And a study by the Government Accountability Office noted that revenue restatements result in larger market cap valuation reductions, that 38% of restatements between 1997 and 2002 were directly due to RevRec issues. And finally, approximately 50% of SEC's enforcement cases have involved RevRec issues. So it's a very significant process and number in the financial statements. And because of the propensity of errors in rev recognition calculations, revenue is always an area of high audit risk. And as we know, it's too often the case that companies' processes are often centered around non-automated and offline systems such as Excel. When we're dealing with voluminous transactions, this can compound the risk of manual errors and ultimately have incorrect postings to the financial statements. A recent PwC article noted that RevRec was one of the top areas of audit risk, and that the failure in internal controls over RevRec is one of the most significant causes of material weaknesses in internal controls. So to mitigate this risk, companies should have clearly defined procedures for the accurate, timely, and consistent processing of orders in accordance with the relevant RevRec standards. And these procedures should be supplemented using strong internal controls and continuous training of the staff and the revenue recognition team. So now let's take a look at EITF 0801. 0801 introduced the concept of estimated selling prices, or ESPs, to establish item line level valuations in multi-element arrangements. This new third valuation element can be used in the absence of vendor-specific objective evidence and third-party evidence. Prior to the introduction of estimated selling prices in 0801, when there was no VSOE, third-party evidence, multi-element arrangement contracts were often recognized as a single element of accounting. So they were unable to break out the multiple elements when there was an absence of VSOE or third-party evidence. However, with the introduction of 0801, the first thing we must do is identify the individual elements within the multi-element arrangement so that value can be assigned to each element, irrespective of the value quoted on the contract or invoice. Once we establish value for RevRec purposes, we then allocate the allocations. To establish item-level valuations, we must first ensure that we have established these standalone ESPs for each item in the contract, and that we allocate the total contract price to each item based on its relative ESP value within the order. So they're weighted right throughout the order based on their relative ESP valuation. So it's important to emphasize that the ESP drives the item revenue valuation, and that this established valuation for RevRec purposes is entirely distinct from the price or value quoted on the contract. So to reiterate, the item quoted contract or invoice price is always independent of the RevRec valuation. For instance, if you sell a subscription service to a customer and you say you're giving the support for free, fine, you can put that on the contract, you can put that on the invoice, but for RevRec purposes, that support does have a value, and that value is established in the absence of VSOE or third-party evidence using ESPs. Next, once we've established each component value for RevRec purposes, we then recognize revenue for each of the items based on the rules or revenue recognition drivers applicable to each specific item. For example, subscription services are recognized as the service is delivered, professional services as the project is fulfilled or perhaps on milestone billing, and hardware as the customer takes possession of the hardware. So now let's address some of the best practices for implementing and adhering to EITF 0801. Firstly, in order to establish valuations for each item, we need to establish the current ESP valuations, which in turn will drive the RevRec value for each item in that particular bundle. So to establish ESPs, we must analyze historical item selling prices across various dimensions. For example, if you have significant differences in selling prices across specific channels or geographies, you may need to consider establishing a unique ESP for each channel or geography. As an example, if you were selling into one particular market at a significantly reduced PS rate or into a specific channel and there was a large variance in the PS rates versus the other channel, what you would do is establish 2 ESPs for your PS services. The best practice is to have a single repository of integrated sales, finance, and services data, as this will ensure historical selling prices are accurate as they are pulled directly off the actual invoice contracts, and you can then automate the ESP calculation process using inquiry reports and saved searches for each item across your predefined dimensions. And, of course, you should continuously monitor the ongoing pricing against established ESPs to make sure that your ESPs are current. Just because you established them 6 months ago, market conditions changed, so you need to ensure that you're continuously monitoring your ESPs to make sure that they're still relevant and applicable. KPMG outlined a simple structured methodology for calculating ESPs. First, you gather all data points. Okay, so you pull all historical invoices for the specific items that you're tracking. You consider adjustments based on market conditions. If there's increased demand or competition for your particular product due to any specific event, maybe you need to sit back and say, okay, my historical selling prices are no longer relevant relative to these changes in the marketplace. Next, you should consider the need to stratify into meaningful groups, as noted earlier, such as geography, channels, etc. Anything where you find large variations by specific segments in your selling prices for a particular item. You should then weight available information and make your best estimate of ESP. You need to establish processes, as said earlier, for ongoing monitoring and evaluation to ensure that they are current and relevant. They have to be current and relevant if you're doing assign correct valuation to each particular item for RevRec purposes. So the best practice is to communicate with your auditors. As this is such a high visibility area and an area prone to error, you must communicate with your auditors as to your methodology and processes and get their buy-in, as this will be a critical area where they will require comfort during their audit. So the mantra should be, you should engage your auditors early and as often as needed. So it's best to have their consensus up front versus having problems at the tail end of an audit or something like that. So you should walk hand in hand with your auditors. Next, after establishing the ESPs based on a centralized data repository, another best practice is to ensure that you have strong integration between your PSA systems and your financials, as your professional services automation systems track the recognition triggers for your PS line items. Often these are significant dollar amounts with multiple contracts or multiple service arrangements happening at a particular point in time. And by having an integrated PSA and financial system, you can automate the recognition of services revenue as the RevRec criteria are met, such as milestones being reached, etc., or percentages of completion. Whereas an offline, non-integrated tracking of PS projects increases the potential for RevRec errors. Another best practice, of course, is to scrutinize and align your financial systems and existing RevRec processes. Ideally, your financial system should automate the calculation of RevRec item valuations for your multi-element arrangements and the recognition of revenue from deferred revenue. If this is happening in a manual process, it's really going to cause you some problems. And most organizations, they seem to have outgrown the capacity of their ERP systems and tend to process using offline processes where the risk of error increases from both an accuracy and timing standpoint when using these offline schedules such as Excel. Particularly, again, as new businesses start to grow, volume increases, deal complexity increases, and contracts themselves become more complex. The offline schedule certainly creates a lot of errors. Another best practice, of course, is to align your sales quotes with your financials, as you must ensure that your system has the ability to manage the sales amount quoted and invoiced to the customer, so your customer is expecting to get an invoice presenting exactly what he signed in the contract, but for internal RevRec purposes, you still need to calculate the independent item valuations for RevRec purposes. Of course, you need to ensure that you're positioned to manage all revenue types. To do this, you must step back and understand all of your various revenues and the required accounting for each item, and ensure that you have the processes and systems in place to handle each individual element. Finally, you should adopt ongoing visibility into summarized and detailed recognized revenue. That's to say that you must ensure that your system has the ability and flexibility to easily support analysis of recognized revenue, and that it will allow you to analyze revenue over specific periods of time, various criteria such as revenue by customer, by item, by region, however you want to slice and dice the information. And ideally, you should have the ability to drill right down to the source transaction so you can substantiate your actual revenue that has been recognized. So you should be able to drill right down to the sales order and review the actual revenue allocation calculations themselves. Now that we have looked at EITF 0801 best practices, before we look at Netsuite's adoption of 0801, I would like to give you an overview of the sales order and revenue recognition environment here at Netsuite. So we process in excess of 1,500 orders monthly. So we have a reasonably high volume environment with a relatively complex set of orders. And orders are broken into three classes: new customers, upsells, and renewals. Now Netsuite is a fully integrated system, and the order life cycle goes from lead to estimate to sales order, where it is then processed for RevRec. We process in multiple currencies, and we break our product out into three product types: subscription, support, and professional services. We have a large number of item configurations and currently maintain over 300 items in our item master file. We comply with EITF 0801, and we use ESPs for all items, as we have now established vendor-specific objective evidence or third-party evidence. We recognize subscription revenue over the terms of the contract, and PS revenue is recognized on a percentage of completion basis using our fully integrated PSA system. So those amortization triggers are automated within the system. Now that you have an overview of the sales order and RevRec environment here at Netsuite, I will discuss how we use the Netsuite service for revenue recognition. As Netsuite is a fully integrated end-to-end system, right through from the creation of the initial project lead right through to revenue recognition, invoicing, and cash collection processes. Firstly, the sales order process is kicked off by the sales team after it's converted in the CRM system from an estimate to a sales order. Next, sales management will review and approve the newly created sales order, and once reviewed and approved, it is then automatically routed to finance, where every order goes through a standard desktop procedural review and a quality assurance review to ensure consistency and quality. After passing the QA review, the order is then run through our EITF 0801 bundle. This is automated, and it automates the item level valuation calculations in accordance with EITF 0801, while retaining the ability to separately invoice the customer in the value quoted on the contract. After the 0801 system calculations have taken place, next the system automatically creates revenue recognition schedules for each order in the item. RevRec journals are processed as part of the month-end close, and these again are teed up, and the processing of these journals is automated within the system. And detailed RevRec reporting and analysis is undertaken to ensure that there are no anomalies or to flag trends for further investigation. And again, we can drill right down to the source transaction to ensure that there are no errors or anything like that. The system continuously monitors current level ESPs against historical item prices that will update in real time to ensure that our ESPs are always still current and applicable. We forecast revenue using the detailed revenue schedules that are automatically created during the revenue recognition process. And we simply run future revenue recognition reports and layered assumptions such as new business, upsells, and renewals. So we do all of this in a fully integrated system with no redundant data input, using automated RevRec calculations in a centralized database. So to summarize, some of the benefits of this integrated approach are, number one, everything is traceable, right through from recognized revenue to the source transactions, even right down to the lead in the CRM system. Secondly, it uses a centralized repository of data. So all data such as item records, customer records, and RevRec schedules are maintained in the one system, which lends itself to flexible and robust reporting. So it's easy to extract data in whatever fashion you need to slice and dice this information. Finally, integration promotes efficiency, as there are no offline schedules and there are no reconciliation issues. Thus, deferred revenue is automatically supported by detailed revenue recognition schedules. All routing and transactions occur within the system, including the automated revenue recognition valuation calculations. And this frees up finance time for more value add to do QA checklists, to perform analytical review, forecastings, etc. And it takes out the manual risk of calculation errors. Integration increases visibility, as deferred and recognized revenue can easily be analyzed right down to the detailed transaction level. So because of this fully integrated system, we are significantly reducing the risk of error. Now that we've looked at the benefits of a fully integrated system, let's look at some of the Netsuite best practices around sales order management. We use a high-quality, cost-effective offshore team of CPAs who are responsible for the end-to-end processing of every order. They review each order to ensure compliance. They execute the allocation using the automated 0801 bundle. They run the schedules, they bill the customers, and they provision the software. All of our team members, as noted earlier, use standard desktop procedures to ensure that they're updated timely and used in the training of new team members. This ensures consistency right throughout the team. A quality assurance checklist is used for each order, and it is included with the Netsuite sales order form. So to summarize, by using standard desktop procedures for consistency, an offshore, cost-effective, high-quality team, quality assurance checklists, and we maintain error reporting and resolution processes, we can ensure that our orders are processed in a timely, accurate, and gap-compliant manner. So I mentioned the QA checklist earlier on. I just want to give you a view as to how this looks within the Netsuite system. It's actually attached to the order, and all critical elements of the order are reviewed to ensure compliance. For example, signatures, dates, RevRec dates, and schedules. Case management can be used to follow up and resolve areas that have not passed any of the QA checks. The order does not continue on its life cycle until it has passed all stages of the QA quality control. So, as NetSuite is a cloud-based software, we also take full advantage of the cloud in our order processing, as the cloud it's ideal for inherently distributed activities such as using semi-offshore finance teams, worldwide distributed sales teams, and also the cloud easily supports temporary or home workers, as all users require is browser access, and everyone has the same view, if given permissions, of course, into centralized data that updates in real time. We call it one version of the truth. So, what are some of the key ERP system capabilities required for supporting EITF 0801? Firstly, it should use a single repository of sales data, and it should fully support detailed, accurate, and efficient ESP analysis across multiple dimensions and currencies. So it should have strong reporting capabilities that you can easily customize and specify various parameters as needed. It should automate the EITF 0801 calculation, and it should be scalable, as this is scalable and can process high volumes of transactions and reduces the risks of error and promotes efficiency and accurate revenue reporting, while you can still use a smaller revenue team. So automating this calculation is really a significant step in improving your processes. Detailed revenue recognition waterfalls should be created automatically and stored within the system, so no offline schedules outside of your system. You need a fully integrated system, and your revenue recognition waterfalls are part of that. Finally, you need continuous monitoring of item ESPs against actual selling prices. to ensure that they remain current, and a system will trigger alerts if average selling prices fall outside set parameters. Here is an example of an EITF 0801 allocation price analysis report. Here's a closer look at the report. You can see we've got sales order, number, date, item class, etc. And again, you can configure these as you want and putting in certain parameters and calculate average estimated selling prices across various date ranges. We've also developed other controls around sales order processing to flag higher risk, large and potentially complex deals for special reviews. The system automatically flags orders greater than a certain dollar threshold, and they are routed to a more senior revenue accountant for review. These orders are automatically flagged to a defer RevRec category to ensure that no revenue is recognized without first reviewing clearing the order. We have 2 internal meetings each month with revenue accountants and finance management to discuss and resolve more complex deals. And also we hold a monthly metric review to review the numbers of orders processed and the types of errors that have been addressed using our QA process. Finally, if a trend is discovered, an error trend in one particular category, we will conduct additional training as required. Now I want to give you a really brief overview of how we use our revenue recognition processes here to support our forecasting here at Netsuite. We take our detailed RevRec schedules and then we layer in assumptions, as noted earlier, for new business, upsells, and renewals. And from this, we generate highly accurate revenue forecasts. We can slice and dice these as required right down to the customer level. Additionally, as we process new orders, we can refresh these forecasts and easily provide updated forecasted numbers to senior management. So using this methodology, we experience a very low variance between our actuals and our forecasts. And here is an example of a revenue recognition waterfall report. Okay, you can see that this one is driven off, I think, customers, but we could also run this on particular items, particular geographies, etc. So again, having flexibility within your reporting. So to summarize, what best practices have worked here for us at Netsuite? With our sales order and revenue recognition processes, firstly, we have very tight integration between the sales and finance organizations in terms of communication, sales order contract best practices, and ensuring that all documentation is complete for sales order processing. We have a full integration between our CRM and ERP functionality, which ensures that we have a seamless flow from lead right through the sales order, revenue recognition, invoicing, and cash collection. With everything in one system, we significantly reduce the risk of error and have no redundant data input or maintain offline schedules. We have a tightly integrated reporting processes, and we use centralized data that updates in real time. Our ERP system is continuously updated with current revenue recognition standards, and it automates the EITF 0801 calculation, so you ensure it's always calculating in accordance with the most current standards. We've automated routing of orders for review and approval. We use standard desktop procedures, QA checklists, and sales order dollar threshold flagging for larger orders. We use NetSuite's case management capabilities to route specific issues to the people who can resolve these issues. We utilize the full benefits of the cloud using distributed teams with all users accessing the same centralized data. And finally, of course, as it's cloud-based, the system is automated with upgrades throughout the year so that all users are running on the most up-to-date version of the software. And I think that should be back to you, Carlo.
Thank you, Albert. I appreciate the sharing those interesting insights and best practices. And this brings us to our first of 3 polling questions. We'll go ahead and launch, and you should be able to see this on your screen here momentarily. And I just want to take this time to remind our audience that for those of you who are attending today's webinar for CPE credit, you must take all 3 polling questions in order to receive full credit. But we also urge all participants to answer the polling question as it is statistical in nature. And if we have enough time at the end, we'll share some results and see what the speakers think of in regards to some of the trends. We also want to take this time to encourage everyone to ask questions in your GoToWebinar panel in the questions box for our Q&A session. I know we have a couple coming up, and I'll give everyone another 5 seconds here to answer and close this polling up. And again, we appreciate you sharing those insights with us, Albert. And now, at this point, I'd like to introduce our next speaker, Ms. Ann Massey. Ann is the CFO of Coverall Technologies. She has served as the CFO of Coverall Technologies since February 2001 and as secretary since April of 1997 and as a controller of the company since March of 1997. From March of 96 to March of 97, Ms. Massey served as the Coverall's assistant treasurer, and from 94 until 96, she has also served as the assistant controller for their insurance divisions. Prior to 1994, Mrs. Massey served as accounting manager for Coverall. The floor is yours, Ann.
Thank you, Carlos. I'd like to go over some background of Coverall Technologies to start. Coverall is a publicly traded company. We're listed on the New York Stock Exchange. We're based in Morristown, New Jersey. We provide software solutions for the property and casualty industry. We have over 60 major insurance carriers as customers. In the last 5 years, we've experienced significant growth, and we made 2 acquisitions in the recent years. So we're growing organically as well as through acquisition. We have modest order value, but high revenue amounts per order. We do subscriptions, we do software license, we do professional services and support. Or we have 5-year contracts here, so we bill quarterly and monthly. So we have, as I said, we have license, maintenance, and professional services involved in all those contracts. We're governed by EITF 0801. We utilize VSOE to properly carve out the price of the various components and recognize revenue across the proper periods and against the proper items. This has been very important to us because we have the SEC has been in and looked at us regarding revenue recognition. It is one of the major issues that they look at. And as everyone knows, in a publicly traded company, they look at you every 3 years. So they tend to look at the major items that you're involved in. And one of our biggest things is revenue. We manage short-term as well as long-term deferred revenue. We have maintenance that we bill out. We can bill maintenance yearly or we can bill maintenance quarterly. And we also do professional services on a monthly basis or a quarterly basis, whatever the service is provided. We were running multiple systems, very not fully integrated, very siloed systems. Our revenue recognition was handled outside these systems on spreadsheets, as Albert had mentioned, and we had one fully dedicated person, and it still was difficult to reconcile. We still had items. We had difficulty reconciling our deferred revenue, reconciling our VSOE, reconciling our revenue. So it was very, very difficult for us to continue maintaining on spreadsheets, and it took us over 2 weeks to close the month, so we had to look at other systems in order for us to move ahead. One of the other reasons we needed to look at other systems as well was because of SOX compliance as well. As I said, SOX brought about the need for much tighter controls, and we needed to segregate duties and establish controls, and we needed support for audits that were longer and more complex. So, and as I previously said, the SEC was also now looking at us on a regular basis, which is consistent with all public companies. We also entered a growth period. We were also growing at that time. We entered a period where our revenue was increasing 2x. We were our manual processes weren't able to handle that volume, and we lacked real-time information, which made it very difficult to manage and grow the company. So we needed to look at a way to better handle our revenue and our forecasting. So we implemented Netsuite. We go through the process of setting up sales orders. We go through an order process where the order is approved, and then when the work is done or the license is delivered or the support is provided, we then fulfill the order. Once the order is fulfilled, then it comes over to finance where we generate. The order is fulfilled in operations, our operating side, so there's segregation of duties. Our operating side provides the order fulfillment and the booking of sales orders. The invoice generating is done in finance, and it's done at very detailed levels because we need that VSOE detail. And we use the revenue recognition template, and we're able to, how we put in the sales order and how we put in the invoice allows us to generate revenue recognition reports to review and allows us to close. And we've reduced our monthly close from about 2 weeks to about 4 days now. One area being the improvement we've seen in revenue recognition. As I said, we've reduced our workload in accounting significantly. We are monitoring our DSOE and monitoring our revenue on a I would say on a monthly basis here. So we were able to move basically from about 5 people who are involved in revenue to about 3 people who are now involved in revenue. So we were able to cut out some costs and get more efficiencies and get more reporting. Our calculations are determine what should be recognized and allocates revenue over the appropriate periods and the lines of business. That is very important for us. We have a number of lines of business. We need to know the margins on those lines of business. We need to know the revenue that's out there to be recognized. So that's been very helpful for us. As well as we centralized everything. Now we have a single source of information instead of multiple spreadsheets that only accounting can see. Now operations as well as senior management get the benefit of the source documents for revenue as well as other costs. The foundation is now built for us to grow. We now have a foundation that's pretty solid that allows us to grow. So we can grow in volume and we can grow in complexity. We acquired 2 companies, one in 2010 and one in 2011. And both companies complemented our solution set. One was a claims provider, one was a BI provider. We were able to integrate that into our revenue recognition process here very easily because, as I said, the system is set up to allow us to do that. They follow all our same processes and procedures, so it's been very effective. It's allowed us to grow through M&A as well as organically. Under the old model, acquisitions would have increased manual work and put a lot of pressure on compliance, and it just wasn't viable. In the current system, CoverAll is able to roll both companies very easily. They're integrated onto our financial systems very easily. We've been able to, in the number of items that we needed to address for SOX compliance, we were able to address those issues very effectively. We were able to address segregation of duties, which was critical in the sales order and the product delivery. We were able to bill up front and recognize revenue over the term. It had positively impacted our cash flow. We're more able to bill and recognize revenue and collections on a more regular basis. And the automation went a long way to reduce the closing process as well as to allow us to see where we're going, allow us to grow. So it's been very, very effective. That's it. Thank you, Carlos.
Thank you, Anne, for sharing your story with us. I really appreciate it. And this brings us to our second of 3 polling questions, which I will be launching here. And you should be seeing this on your screens here momentarily. And this is great, and I appreciate you and Albert taking the time and making sure that we leave a good amount of time for some Q&A. We do have some questions that have come up throughout the event, and we still encourage all of the attendees to utilize this chance to speak with both Anne and Albert and seeing what their insights and best practices that they can share based around some of the questions. Please leverage the questions box in your GoToWebinar panel and we will try to get to as many as we can during this session, and it may even look like we have some time to share some of the results from our polling questions. I'll just give it another second here before we move on to Q&A. And so, Albert, this question actually comes to you, and please feel free to jump on this one as well. But Albert, can you share any recommendations on how to work effectively with your external auditors around proof, documentation, process, workflow? Kind of generalizing it a little bit now, but whatever you can share with us, that'd be great.
Sure. Well, as you know, it's a critical area for auditors, the RevRec process. So basically just have an open dialogue with your auditors at all times. Let them come in early and say, here are my revenue recognition processes. Are the controls sufficient? Here's how I'm establishing my ESP or my VSOE, etc. So basically, it's best practice to make sure that these guys buy off on your processes before you start engaging in putting those processes in place. So just an open line of communication, because then there's no surprises when they come at the quarter end. So it's literally, I would say, pick up the phone to your audit manager and say, here, we need some advice when it comes to putting best practices in place around our revenue recognition processes. So an open line of communication. I bet your auditors will be more than happy to help.
We have also walked them through the process, which was very effective. They came in, they did an actual walkthrough of the process and saw how the process worked, so that was very effective too.
Mm-hmm.
Fantastic. That's great. Here's another question from the audience. How often, and Albert, this is more to you, and it came up during your piece, but and again, please feel free to join on this response. But Albert, how often do you see fair values established at the highest element level? For example, hardware, software, at 40% off the list. An example more from rather than an individual part or part and channel level. And I know this is kind of a two-part question, so apologies, but establishing fair values at the highest element, how often?
Okay, well, obviously in the software business, we find you could establish a rule initially if it's a new service, for instance, based on your historical experience, saying, okay, this is my list price, however, my average selling price might be 30% based on historical transactions. So you may start your ESP if it's a brand new item at maybe 30% of list price. Seldom would you find your ESP to be exactly in line with your actual quoted price. So not very often. And then depending on the volume of transactions across various channels, if you have if you don't have a significant or material volume of transactions in a specific channel or geography, then one dimension is quite fine for a particular item. Yeah, but you should have a set rule in place as to how your item list price deviates from your ESP price, and you could maybe introduce that rule at the start of establishing your ESPs.
Great, thank you, Albert. I appreciate that. And any kind of follow-up to that, or?
We've been very effective in going back and looking at historical prices. Our support prices are annual renewal prices. You can use those. We use those in terms of support. In terms of license, it all depends on the elements that are involved in the licensing and professional services. So ours is a little complex, but we look at the license, which is the higher end item first, and then we look at the support and professional services.
Mm.
Fantastic. And I want to take this time actually, and it allows to kind of set the stage. I want to share the results of the first polling question, if I may. Both Ann and Albert, I'm not sure if you can see the results on your screen, but the first question was, the most difficult thing about revenue recognition for my company is, and there were 5 options. The option that got the most kind of attention was making sure we apply all revenue rec regulations properly. Now, the question from this, and I guess where I want to get your insights first off is, does that surprise you? That some of the other options to answer were avoid wrecking our established VSOE, coming up with ESP for our products, reconciling all other sales order. But the number one that came up was making sure that we apply all of the RevRec regulations properly. Is that a surprise to you guys, being in the field, also utilizing what regulation we have and ultimately building a process around it?
That's not surprising to me, because it is very important that it be looked at in total, that it be looked at, all the processes be involved, all the regulations have to apply, have to be looked at in order for you to properly assess, where you're going. The other thing is, too, it can be industry specific. Like in case of us, we're a software company, so the revenue recognition and the different types of revenue that we sell also have to be identified and looked at on that basis as well. So.
And I'll just add one thing. The landscape is also changing, as there's a forthcoming exposure draft where I believe it may become effective. I think it's January 2017. It hasn't been finalized yet. So this again will change our revenue recognition guidance, and the adherence requirements will also change. So, I believe the actual standard itself will ultimately be fairly close to 0801, but we may have some retroactive reporting as well. So you may have to report back on 2015 and 2016. But the landscape is also changing, so it's best to have advice from your auditors again as to what's best practice and what standards they should follow.
Great. No, thanks for that, Albert and Ann. And here's another question for Ann. There's an audience member who's a private company. They have the aspirations to go public. What impacts does being a public company have on RevRec, and what type of recommendations do you have for a company that is planning to go public?
I would say you have SOX compliance. You have that in private and public, but you also have the SEC review, which can come up as well. So your processes have to work with your auditors as well, but you have to be able to explain them to a third party and be able to have the necessary documentation, because, as I said, we have had the SEC, which they do on a normal basis for publicly traded companies, look at our revenue recognition policy and procedure. And it is very important that if you are public, that be nailed down with your auditors and be looked at and reviewed on a regular basis, as Albert said, for any changes that come along.
Great. And Albert, any follow-up to that? I mean, obviously Netsuite's a public company as well, but I mean, in the sense of going from private to public, there's a different sense of the statutory reporting that's required. And ultimately, is there anything else that we can offer? And I'll tackle on another question from the audience. And I'm sorry, guys, I keep doing. There's a lot of great questions here, and I'm just trying to get to as many. There's a lot of new kind of verbiage and a new taxonomy that's coming out, and it's kind of more so over the last few years. And for some small companies, it's a little difficult to get in the know of some of the new vocabulary and ultimately the regulations, and everyone's got a day job. They need to manage their internal financial reporting as a small private company. But as they're growing and they're wanting to go public, what are some of the tools or outlets that they can leverage to just get better educated on the regulation and ultimately the compliance requirements they need?
I'll take that. But first of all, I'll just address the prior question as well. Just before a company files an S1, before they go public, obviously they should start operating as if they were a public company and prepare their financial statements as if they were filing them with the SEC, etc. So while they may not be required by the SEC, because they're not public yet, to adhere to all of these standards, they should start adhering to these standards. Otherwise, they will not be able to file their S1 and ultimately go public. So as soon as possible, they should start reporting as if they were a public company. And relative to how do you get updated information as to what current standards are, etc., again, I keep deferring to our auditors, but for instance, I was just on a KPMG call recently referring to the new exposure draft. So if you talk to your auditors, they always have best practice or thought leadership, webinars, etc., and documentation, etc. So if you just reach out to these guys will tell you exactly what's coming down the tracks. And I keep deferring to your auditors, but you pay them for their services, and they have all of that knowledge.
Fantastic. No, that's great. And hopefully the audience leverages all of the value channels that they have access to in their current workflows. So definitely a great comment. Here's a question for both of you. This is coming again from the audience. They're a small company but growing rapidly. They're currently using spreadsheets. At what point does it make sense for them to have a much more sophisticated RevRec solution? And an extension to that, are there any certain milestones in terms of revenue or other indicators that they should look for to trigger that change in spreadsheets to a more broad-based solution?
And do you want to take it?
Yeah, I'll take that.
Okay.
I think as you see the company grow and you want to provide information to senior management, it is imperative that you have some system that works, that is integrated. You also need to work with operations as well to understand they're the ones delivering the product or whatever, or servicing the customer. So there needs to be communication within the whole company. It needs to be through a system. It just is much easier. What happens on spreadsheets is that errors can be made. Not everybody has access to them. People that, things can be missed. We had spreadsheets, and I'll tell you, we missed revenue. When you go back and reconcile, sure, but it's always there's something missing or something's not captured properly. So this and it cannot necessarily be found by somebody in finance. It may be found by somebody in operations. So if everybody has access to all the same data, it allows for easier reconciliations and revenue recognition.
Great, thanks for that, Ann. I'll try to get a couple more in, just keeping the notice of the time here. And so there's a question that's, and I'm trying to phrase it so that we can get kind of general on it as well, and kind of get enough insight from both you, Albert, and Ann. Different areas of a business are governed under different RevRec guidelines. Some are under the FASB and others on the IASB, and ultimately from financial reporting, IFRS, and GAAP. But what recommendations do you have to ensure that they're applying the guidelines appropriately and consistently? Any insights on that end?
It is all through process and procedures. It's all through procedures that you develop internally within the corporation that are looked at by your external auditors, as Albert said, to make sure that you're following the rules, as well as there's a policy and procedure, because you don't want anyone to go outside in the company, outside of the policy and procedure, because it will not be effective, and it will not help you with your revenue recognition process.
I agree 100%. The policies, processes, and procedures should mirror the actual standards themselves to make sure that they're affected correctly.
Great, thanks for that. And then I'll wrap it up with this last question, and this is going to go to both of you, and it's specific to the NetSuite and how you NetSuite platform and how you leverage it. But can you guys share some of the best practices and ways to substantiate, establish the SOEs for external auditors, specifically using the NetSuite platform?
Well, we were able to put the very detailed information on our invoices, and so we were able to determine the pricing for different products, and we're able to keep that, and you can see it consistently across all customers. So what you see is the invoice has all that detail. It's in the contract as well as in the invoice, but the invoice allows it then, if you want to look at it across different lines, and you also want to capture that information across different lines and understand the different prices for different products and different, revenue types, it's available there in NetSuite. NetSuite allowed us to grow and to put that information in there. before, if you do it manually or whatever other system, you have to look that it's able to handle that volume of information and that level of detail.
Great, thanks, Ann. And Albert, any follow-on to that, or?
No, I pretty much agree with Ann. You know, if all of your data has been captured and your invoicing is occurring within a central system, and you know, you can easily pull reports to see have you got consistent pricing to establish and maintain your VSOE. But again, having all of this historic information in the one system will allow you to prepare reports upon which you can establish your VSOE, if you can establish it.
Fantastic. And you know, unfortunate as it may sound, we do have a few more questions in queue. So I appreciate both Ann and Albert taking the time and sharing some great insights and best practices from a first-hand perspective. And apologies to the audience members' questions we couldn't get answered during this time. But we will work with both Albert and Ann to get them answered for you directly after today's webinar.
Mm-hmm.
And so just some last-minute wrapping up items before we let you get back to your busy days. At the end of the webinar, you will be prompted to participate in our short survey, and we truly value your feedback and appreciate your time to help us to continue to deliver great content. At that time, you can easily request to connect with both Albert and Ann, as well as Netsuite, with the click of your mouse. And we also encourage you to join us on Performative.com to continue this great discussion. We'll ultimately post some of the responses to the questions there, and it'll give you guys some more insights and a tool to leverage while you go down this journey of revenue recognition. And any questions regarding CPE credits, please contact Chris Brower at Performative.com. And just wanted to do a quick reminder, we are about 8 days away from our inaugural Performa Tech Conference, which will be held at the Hyatt SFO next Wednesday, the 20th. It's a great event where we'll have some world-class speakers talking about the new fintech technologies out there, things that are best practices, lessons learned, and a lot of great CFO speakers on the docket. And we'd love for you all to be there. It's free and a great event. And we ask if you can just visit proformatech.com to get a little bit more insights around that. And lastly, I want to thank Albert and Ann for their time and insight today. Again, both of you are great subject matter experts in this field, specifically from a practitioner and kind of first-hand perspective point of view, which is great. So I really appreciate you both making the time today. And I also want to thank our sponsor today, Netsuite. We appreciate the support of our sponsor and, again, our speakers to bring you all the great content and knowledge that we shared during today's webinar. And before we end the webinar today, and we'll go ahead and launch our third and final polling question. And all of you should be seeing this momentarily on your screens. And again, after we close down this last polling question, I'll go ahead and close down the webinar, and you'll be prompted to take the short survey. If we can please ask you to answer so that we may get better at delivery or delivering the right type of content and webinar to you, we greatly appreciate it. Also there, you'll have the opportunity to request the connection with the speakers and the sponsor, and as well as sign up for our Performa Tech event with the click of your mouse. I'll just leave it open for another 5 seconds here, and we thank everyone again for taking the time out of your day to join us here on Performative, and we look forward to seeing you guys all on Performative.com or one of our other events. Have a great rest of the day, folks.